Hi, welcome back to Market Focus. It's June 23rd, 2020, and I'm Brad Levin, coming to you once again from my home office where I've been working remotely for the last 3 months. Now, since then, we at Legacy Wealth Partners have actually been quite busy working remotely. We've been talking to our clients every day. We've been doing a number of great, widely attended Zoom chat sessions. In fact, watch out for future dates. And we've gotten some introductions to some new clients who were looking for a change or investment approach, but they want a more proactive financial guidance. So we always welcome those introductions. Now, 2 months ago, I did our 5-part video series entitled The Market Volatility Survival Guide, and I laid out for you the expectation that the recovery was going to be inevitable. I just didn't expect it to be this strong or this fast. So the S&P 500 has gained more than 30%, and today is down just 3.5% from where it began this year. It's really incredible. At that time, I also said that one way that investors could help rebuild their portfolios would be to rebalance, to reduce bond allocations and increase stocks to lean into the recovery. I also said that you could utilize volatility to your advantage by using dollar cost averaging, or the systematic approach to investing capital at systematic levels over time. And I also said that you could invest individually in stocks that were beaten down much worse than the market, but were quality companies that were poised for rebound. Well, we've done all those things, and that's worked out really nicely. But a lot of people are scratching their heads today saying, how does this even make sense? We have a very divisive political environment. We've got an incredible level of social unrest in our country that's very disturbing. And we still have an economy that is really badly damaged that needs to be rebounding. Why is the stock market so high? Well, we have to consider the context that we've never experienced this level of economic stimulus like we're experiencing right now. The federal government has sent out checks to businesses and consumers totaling in excess of $3 trillion. That's incredible. Also, the Federal Reserve has brought interest rates down to zero, and they've also injected about $3 trillion of capital to the economy as well, over $6 trillion combined. What this means is there's a lot of potential spending to come back online as the economy starts to rebound, and we're already seeing it. May retail sales increased 17%. That's a huge improvement. What we also know is that savings accounts and checking accounts of families have really been ballooning. Bank of America reported that their average balance is up by 20%. We also know is that the stimulus checks that went out to people, a lot of that money just stayed in checking accounts because they didn't need to spend it. They were at home, sheltering in place. So we actually have an opportunity for corporate earnings to rebound strongly, and that to fuel a strong economic recovery. Even though stock valuations are stretched at these levels, we feel the stocks are more attractive relative to bonds and cash at such low interest rate yields. Also, our view is that the large company stocks have rebounded strongly, but there's a lot of opportunity left in the market in small and mid-cap stocks, and also now some rotation into international and emerging markets that have been kind of left out in this recovery so far. So that's our view. We feel that any pullback is an opportunity for investors to take advantage of. And I want to thank you for taking the time to listen today. We'll be back soon.